S&P Dividend Aristocrats plus risk control equals participation and protection. Over the past 80 years, dividends have accounted for over a third of the total return of the S&P 500. Chances are, if you're an investor seeking sustainable income with increased return potential, dividends already play a significant role in your investment strategy. But not all dividend strategies are created equally. We designed S&P Dividend Aristocrats to isolate quality dividend growers in order to maximize return potential, minimize volatility, and provide steady cash flow, even in down markets. So what does it take to become an S&P Dividend Aristocrat? Put simply, an impressive track record of consistently increasing dividend payouts to shareholders over many business cycles and market conditions. S&P 500 Dividend Aristocrats consist solely of blue-chip companies within the S&P 500 who have managed to raise dividend payments every year for at least the last 25 consecutive years. With so many possible markers for company success, why the focus on consistent dividend growth? First, requiring 25 years of growth and not just paying dividends shows that the underlying business model is solid, managing continued growth over many business cycles and, in some cases, even across management teams. Secondly, it indicates that as the company grows, the company's management is committed to increasing payouts to shareholders. Some companies in the index have managed to increase dividends for over 50 years, twice the minimum requirement for inclusion in the index. They include well-known firms such as 3M, Coca-Cola, Colgate-Palmolive, Procter & Gamble, Emerson Electric, Johnson & Johnson, as well as lesser-known companies like Genuine Parts Company and Dover. And the Dividend Aristocrat framework yields additional benefits. Unlike indices that focus solely on high dividend yields, which typically hail from the financials and utilities sectors, each company in the index is equally weighted and treated as a distinct entity regardless of size. This means that S&P Dividend Aristocrats are well diversified across all sectors, and single stock concentration risk is eliminated. This diversification provides downside protection and a number of possible routes to upside participation. Over the past quarter century, S&P 500 Dividend Aristocrats have consistently outperformed the S&P 500 while demonstrating lower volatility. As one of the first dividend strategy indices created, the index has over a decade of live history and almost 3 decades of back-tested data demonstrating its ability to deliver higher risk-adjusted returns, lower volatility, and downside protection. To offer further protection, the S&P 500 Dividend Aristocrats risk control family uses an overlay designed to maintain risk at a predefined level. The risk control framework is applied to the underlying index, which helps to reduce portfolio volatility toward the target, whether it be 15, 10, 8, or 5%, by moving a portion of the portfolio allocation from the underlying index to cash in volatile markets, and from cash to the underlying index in less volatile markets. The end result? Market participants limit risk while remaining invested in the underlying equity index when market conditions are more stable. It's participation with an added layer of protection. When it comes to dividends, history has shown that selecting from the cream of the crop can lead to reliable income, lower volatility, and greater return potential. By focusing on consistent dividend growth as a measure of company performance, longevity, and growth, S&P Dividend Aristocrats provide direct access to blue-chip companies, the sustainable dividend income they have consistently delivered, and the volatility and downside protection provided by sector diversification and equal weighting. To learn more about unlocking the potential of S&P Dividend Aristocrats, visit www.spdji.com.